Well, good afternoon, everybody, and welcome to the mid-December 2020 Bull Sessions. My name is Mark Robertson. I'm joined here by my dear friends, Ken Kavula and Kim Butcher. Say hello, guys.
Hello, everybody.
All right, and again, this is one of these more informal, but this will be a little more formal than usual. We've got a pile of questions. And this was kind of inspired by spending some time with investment clubs. We really love the time when we can go face-to-face with clubs, but the cyber world means that we're attending via Zoom and that sort of thing. And what we've put together is kind of a set of 20 questions. Some of you probably remember the TV series Love American Style. That's what that center graphic is down below there, 20 questions, investment club style. And what we basically want to invite you to do is, wonder as we wander through things that are affiliated or associated with manifest investing, but long-term investing in general. And I would encourage everybody to think of it as, isn't that a cool picture on the lower left, Ken? I
really like that, Mark. What is that?
We have to go find that. It's in Ann Arbor or somewhere near Ann Arbor, Michigan. But I can just, what I want the audience to do is just kind of curl up. We'll put a little fire pit in the middle of that gazebo, one that meets code and is safe, of course. But pull up a chair and just kind of sit back as we go through some of this stuff, and let's have some fun for a few minutes.
Is that actually a gazebo? I was kind of thinking it might even be a wishing well,
Could be a wishing well. And a wishing well is certainly an appropriate topic for investing, too. All right, here's our standard disclaimer and reminder to everybody. No investment recommendation is intended. We won't talk so much. Well, there are some real companies in here in real time. This is an educational demonstration intended to be for demonstration, illustration, all of that type of stuff. It is about sharing the experience and wisdom and lessons learned over the last 8 decades by the modern investment club movement, whether it's the interpretation of the teachings of George Nicholson and the National Association of Investors, now better known as Better Investing, or the interpretation of those things as promulgated by Manifest Investing. The views are our own. We do try to disclose when we own a company that's talked about. We do a monthly webcast, which is a whole lot of fun. It's on the last Tuesday of every month. And it's just all of us coming together to pick a favorite stock and show how we study it and why it's a favorite. And if you'd like to be added to the email reminder list for that specific event, Roundtable Reminders, please email nkavula1@comcast.net. For those of you that are new, and we do have several new names on the program, the annualized rate of return of the selections we've made since July 2010 now stands at 18.5%. So we not only have fun, it can be rewarding for those that use it as a source of ideas. That, by the way, is what manifest investing is all about, the sharing of ideas and the discovery of ideas with investment potential. If you have any follow-up questions or would like copies of the slides, those of you that are manifest investing subscribers know that we put copies of the slides in the forum. There are slides here in the attachments also, but please send me an email, markr@manifestinvesting.com. All right, just as a reminder, we're doing these every Tuesday just to kind of share what's going on. I'm in the middle of the update. I continue to see on a very global basis a strengthening of expectations for 2021, 2023, 2024. I think we might be turning the corner a little bit. What are your thoughts, Ken and Kim, on a economic perspective right now?
Well, I guess, Mark, since I felt that the pendulum had swung way too far to the negative side 2, 3, 4 months ago, I guess it's only coming back to what I would consider normalcy for it to be back and improving a little bit right now. I really am feeling much more confident with the beginning of the vaccines being rolled out and everything, and I'm just sitting here hoping that my confinement to the home has a definite date where I can leave without a fear of catching something. So I'm looking maybe for the beginning of April, middle of April sometime. I'm just feeling much better about the whole situation, although the market might be a little bit overheated right now. I think that if we do correct, it's going to be something that will be a short-lived kind of a thing, and that as the economy comes back, things will move in the right direction for us.
Yeah, do you think we'll need the full-size RV when we do go on the road again?
I
I
guess it
joke
depends on
everybody, but it's a
I
story
guess it
for another
depends on
day.
who you're traveling with, Mark. Okay.
It's a story for another day, but whoa, what an adventure. Kim, your thoughts?
I just had to go help mom in the other room. So my thought is, I don't know the conversation, but I'm back.
Just basically saying we're talking about, is the economy turning? We're seeing improving fundamentals in some companies. And is that kind of what you're seeing also?
It is, and I'm seeing a whole lot of information on rotation of sectors, especially in the micro cap and small cap. Make sure you have your stocks picked out in that area.
Oh my gosh, that's a good segue. We're going to talk a little bit about that in a few minutes, but specifically, Ken, are you aware that we're up over 20% on our best small company stocks since Halloween?
I've been keeping an eye on it, and it seems to be two or three of them just seem to have taken off and done something that we never anticipated. But as a group, they're doing fairly well, But I have no explanation for the two or three at the top, Mark, that have just kind of run away from themselves at the moment.
Yeah, we'll cover that in much greater detail in coming weeks. But I just want to say that for the first time, I did not buy the one that's in last place, and I actually have a couple of them that are up towards the top. So this is a really good sign. Again, knock on wood, as Kim likes to say. All right. We'll go back to our regular scheduled programming in the bullpen as soon as we're done with these questions, and we don't know when that's going to happen. So let's go ahead and get started. All right. I think this one is a nice capture of a situation. Again, these questions were compiled by investment clubs, and this particular question cites a bunch of performance statistics about the Better Investing, the magazine of the National Association of Investors, and the 100 is the top 100 stocks held by investment clubs, and they show a total return index, and we talk about a return for one of our demonstration portfolios known as Tin Cup, etc. And the questions they're basically asking is, coming at it from 35,000 feet, Mark, what do you feel really is the advantage of the type of investing that this community does? And I'll start, Ken, and then you can please feel free to kick in at any point. The first thing I would make is there's a number of things quoted on this slide from different time frames, and you want to avoid doing that anytime you're looking at performance of something. They're talking about multi-year stuff and just a variety of different time scales. I put them all on the same time scale, so we are looking at just the last 5 years. And when you do that, you end up with Tin Cup, our model portfolio, coming in at about 17.5% annualized rate of return over the last 5 years. The Value Line arithmetic average is the 1,700 companies in the Value Line investment survey. We'll come back to that, but notice that is actually at a relatively low level compared to these other entries. Here's the BI 100 total return. That's a handsome number, 14% over the last 5 years. This one kind of stunned me, Ken. The Manifest 40, it's very heavily weighted in companies like Apple and Microsoft and Cognizant and Fastenal, the 40 most widely followed companies by subscribers at Manifest Investing. And it's really kind of cool to see that one doing so well, because it is going to be large cap, large company biased. Those are the ones that end up on that list. And that's important, what we'll come back to here in a minute. The Wilshire 5000, again, has come in roughly in that same level, somewhere around 14% over the last 5 years. And then this notion of an average investor, again, as measured by the studies done by Dalbar, D-A-L-B-A-R, Dalbar, coming in behind the pack. That's because these are the people that listen to hot stock tips at the barbershop and the hair salon, or they buy what's on the cover of magazines and newspapers, or whatever the talking heads are spewing on CNBC. You want to be careful with buying anything that's hot, and don't be guilty of chasing performance. And so I guess the way I would boil it down, a couple of things, but starting here, well, let's start down here. One of the things that we do at Manifest Investing that's different, and I want to encourage everybody to think about just this perception. I don't think we're dealing with two different stock investing approaches. They're the same thing. I am a champion or an advocate of the Modern Investment Club movement and the works of George Nicholson, and not two different things. The one subtle difference is we pay a lot more attention to forecasts. We're going to show that in great detail as we go. When we go away from here, if you have more questions about what we're talking about, I would invite you to go with Robin Williams to that Oh Captain, My Captain article, where we talk about putting a heavier emphasis on the windshield or forward-looking estimates when we do our stock studies. And the second thing that I think we probably do with a little bit more emphasis, I'm not going to say better, I'm just going to say more emphasis, is our emphasis on discovering and owning the better small companies. And that is something we'll talk about in much greater detail. What grabs you, Ken?
Well, Mark, what grabs me is the BI 100 total return. I'm not a particular fan of the BI 100 because I think that there's a lot of inherent bias in the list of stocks themselves. I know from visiting as many investment clubs and talking to as many better investing members as I do on a regular basis and have been doing for 25 years or so, I know that there's a little bit of a bias against selling, especially in investment clubs that have been around for a reasonable period of time, and especially in investment clubs that have fairly large portfolios. They get really worried about tax implications. They get real worried about spinning off capital gains, and they tend to hold stocks. And I think that bias creeps into the BI 100 total return. I'm just not certain that those 100 stocks are the best stocks from a better investing standpoint to be holding as a group. I think there's a lot of companies that are past their prime on that list. There's a lot of companies that have moved into, how's a nice way of saying it, into value stocks rather than growth stocks.
Mm-hmm.
There's a fair number of companies that have moved from being very dynamic small companies and medium-sized companies to being very mediocre large companies in that list. And again, because of the implicit bias from the Better Investing membership against selling, I think that they end up on this BI total return list only kind of out of just, they're there because they've always been there. And yeah, they might not be in the top 10 anymore, but they're certainly still in the top 100. So I don't trust that BI 100 total return as much as other people might take a look and say, that's the better investing viewpoint. I also like the fact that the value line arithmetic average, whenever I take a long-term look at it, it tends to hover between 9.5% and 10.5%. I think it's one of the best indicators of the total stock market that we have. And it bears out that number that we've been using from history of the stock market having about a 10% growth. We've always referred to value line arithmetic average as all of the above investing. And when you do that in large numbers of stocks, you lose some of your diversity, obviously, but I think you move towards buying the whole market. And when it's around 10, I'm feeling pretty comfortable at that point.
One of Ken is hitting on a very key concept here, whether it's the BI 100, in fact, for the Manifest 40, it also applies. You're going to have large company bias just because those are the companies that are going to be appearing on the most, dare I say, ballots, investment club rosters of companies. But the one thing that you do want to kind of take away, and we will be talking about this, the Wilshire 5,000, obviously it's 5,000 companies, but do you realize that the top, I think it's 8 companies account for like 30% of that gold bar. So the hidden message here is the smaller companies in here are a gold mine right now. The smaller companies, the faster growing companies, not just in the value line arithmetic average, but in general, they're just gold mines right now. All right. I thought I would just throw this slide in just to underscore that statement that we're not talking about 2 different approaches to investing. We are advocates of the stuff that George Nicholson has taught us and the lessons going back over 8 decades. You can say the rules any way you want. These are the things we believe in. And I included some pretty quick reminders. We will have another death of equities cover of some kind, probably with a bear on the cover of Barron's. We do think that quality is the way that you protect yourself and insure against some of the turbulence of terrible economic times. There is more to picking stocks than dartboards. Ken already talked about a little bit. The challenge of when to sell is part of it. But most importantly, riding on the shoulders of giants over the decades. Your thoughts, Ken?
I can't agree with you more, Mark. I especially, am drawn to 2 words on the slide: patience and discipline. And if I didn't learn anything else from Better Investing and from Manifest Investing over the last 25 years, it's that I must be patient as I invest, and I must be disciplined. I must know what I'm doing and why I'm doing it. And that second part of that sentence is frequently something that a lot of people kind of gloss over or ignore completely. They know what they want to do, but they have no idea why they want to do it a lot of times.
All right, so let's go ahead and press on. That's just simply seconding that motion. What I thought we would do is spend a few minutes. Many of the clubs that we visit and sessions that we do, this is certainly something that they want to talk about. So let's talk about. We think that the quality of a company and the return forecast, known as the projected annual return or PAR, are the 2 most important things that you need to understand about any company, with a close honorable mention to the growth for the company. And when I talk about growth, I'm talking about usually sales or revenue growth, top line growth, which we're going to talk about here, or in some cases book value. We'll talk about that later. But we basically take a look at any company and just try to build this vision of what that company might look like in 5 years. And I'm serious about this. We literally collectively put our feet up and imagine what that company might look like 5 or even 10 years out. And under those set of assumptions, what will it be worth? That is literally all you're doing with a stock study using our traditional methods. And in this case, we're looking at O'Reilly. And this is the point I wanted to make. This goes back to that Robin Williams footnote a couple slides ago. What we basically do for any company is we attempt to understand them. You start at the top line at the sales or revenues, and you take a look at what has history held for the company. In this case, from 2010 to 2019, those numbers are found right down here. Those would match up 99% of the time with the historical data array in Value Line. Okay? And then these next 3 years, and then this point out on the far right, those are 4 forecasts. These forecasts here in the 2020, we're just about to wrap up, which means we'll have this number here in a few weeks. These are the analyst consensus estimates, and the data comes to us at Manifest Investing from Y charts. We actually embed those in this picture along with the 3 to 5 year forecast from Value Line to form this red line, which is nothing more exotic than the slope of the trend line through that data. And in this case, it's 7%. So you're looking at a 7% trend line. So in this case, O'Reilly would happen to be the largest holding of the investment club that I was interfacing with. And we took a look at O'Reilly. And by the way, fun fact, O'Reilly was purchased by the Mutual Club of Detroit back in the 1970s, back when they probably only had like a handful, maybe a dozen retail outlets, and followed by the Mutual Club of Detroit for at least 30 years and held as a is a wonderful holding. So we start at the top line. The math is down here for those of you that insist on seeing the actual numbers crunched out. But that is literally how we look at companies. Again, with emphasis on we include, as we are looking at the big picture for any company that we're trying to close our eyes and imagine, the analyst estimates going forward, along with that long-term 3 to 5 year estimate. Anything on there, Ken, that grabs you?
Other than the fact that this is the same type of analysis we do on a stock selection guide, and the only difference is that we stop the data at the 2019 data point, which is something that's factual, and then we project from there. Mark also projects from there in Manifest, but he does include the projections from 20, 21, and 22, which will temper the slope of the growth of sales. It might increase it slightly, it might decrease it slightly, but it will temper that slope of that line. And we think, he and I both think, that gives us a better feel for what the growth's going to be to that 5-year period. And we're still doing the projection 5 years from where our last data point is. And the last data point at this particular moment is third quarter 2019. And we're actually projecting from that trailing 12-month number. And it's right there in the facts and figures. It's 11,260. That's 11,260 million in current sales as of that quarterly point.
Okay, so what you're basically looking at is an image or a vision that O'Reilly could be a $16 billion company 5 years from now. All right, and we're going to come back to how updates and update frequency and how these numbers change in a future slide, but that's basically kicks it off. We use the preferred procedure for everything that we do at Manifest Investing. The preferred procedure, if you don't understand it, I would wholeheartedly urge you to dig in if you're a newcomer. It literally is understanding the income statement from the perspective of the current situation versus what you might expect 5 years from now. So all we're doing here is adding a few more things in where, again, you start with the sales. That's the straw that stirs the drink, in combination with the profitability of the company, which is the bottom line. That's what you see depicted here. Again, 2010 through 2019 being historical data, and anything after that being a forecast. So that's the earnings situation. We convert the earnings, again, it's the earnings or the net income divided by the sales, to a net margin number. This is very comparable. It's a first cousin to what you see in section 2A of a stock selection guide. We just focus in on the net margin for now. What you're literally looking at is a company with improving profitability, and the trend is very strong. I don't believe it can go up forever. In fact, I think this will probably be plateauing, somewhere in that range, but at least you have a visual look. I don't care if you're a person that's completely number phobic, you can come to grips with that profitability picture and start making some conclusions from it. So armed with the trailing 12-month sales, the sales growth forecast, and the projected net margin, making an assumption about projected shares outstanding, you actually do end up with earnings per share 5-year forecast. Profitability matters. Any thoughts, Ken? Is this visual enough?
I think the visual speaks for itself, Mark. It's what we do in a stock selection guide using slightly different figures, but we must understand whether we're looking at manifest investing or better investing, we must understand that both tools are not giving us exact answers. Both tools are being used as a guide or an aid to our judgment. We know right off the bat that when we get a par number on Manifest, or when we get a par number at the bottom of our stock selection guide, that number has pluses and minuses attached to it. And when it says 9%, that's usually 9 plus or minus a couple percentage points. We're not hitting exact values, but we're trying to give ourselves a boost as to what companies have the chance of hitting numbers that will improve our portfolio.
All right.
Yeah,
Go ahead.
there's another thing. Oh, if you can go back there, yeah. I remember watching a lecture on YouTube by Monish Prabhai because he had dinner with Charlie Munger, and I'm a fan of Charlie Munger. And if you'll notice on these O'Reilly shares, notice how the share count has been going down from 141 million in 2010 all the way down to 68. As Mark, you've got in that box, profitability matters a lot. And O'Reilly has been a huge buyer of its own stock. Notice the decreasing number of shares outstanding and how the profitability trend is. Many of you may not know, but I read all the time.
We know
but
that.
Munger believes you only need 3 types of stocks. And one of those stocks he thinks you need are carnivores, where you have great management and management will buy back its shares when they are undervalued, and it gives it better returns. Look at this company. Exactly. That's one of the things that all of us should look at when we are looking at our stocks to see what is the number of shares outstanding done. Is it going up, going down, or staying the same? Because that profitability will be affected by what those shares are doing.
Yeah, and that's a great point. In fact, we're going to come back in future weeks, probably in the first quarter of the next year, and really look at buybacks. And this would be a situation where we would look back specifically at how smart has O'Reilly been over the years. We're going to answer that question. And then we'll also be probably exposing a few companies that do regular buybacks that aren't very smart. So there's a little tease for you. All right, so here's a look at the actual formation of that number, the projected annual return, using those key points of the trailing 12-month sales, the growth rate going forward that we were featuring so much, the projected net margin from the visibility, projected shares outstanding, as Kim was just talking about. And again, if we use a PE ratio, that's what you're looking at here, the visual characterization of a PE ratio. These are price bars up here in the upper chart, highs and lows for those calendar years. The P's divided by the E's, which are the earnings, generates this graph down here at the bottom, the PE ratio over time. And again, visually, I think you can make a case for anything in the 18 to 22 range for this type of company. Value Line, I believe, is choosing 19 right now. So if you basically take that 7% sales growth, 14% profitability is measured by the net margin, apply a PE ratio in the future of what is reasonable and feasible, 19, we find a stock that is trading at a point where the projected annual return, that's going to be the return forecast, is approximately 8%. In this case, 7.8. That's what Ken is talking about, matching up with Section 5 of a stock selection guide.
Mark, I want to smack this on the head once again, okay? Because I think
is this going to be painful to me?
I don't think so.
Okay.
But too often, I think we get down to this par value, whether it's in Manifest or whether it's on the stock selection guide, and we start talking about that par value as if it's a single, exact, realistic number. And all of us that do this work, all of us that have been involved in these processes for all these years, understand there's a lot of tolerance in that number. There's a plus or minus attached to that number, and that 7.8 might very well be 9 or 10, and it might also be very well at 5.5 or 6. And we have to keep that in mind as we're making final decisions for our portfolio.
Absolutely. So yeah, wiggle in any one of those wiggles in either direction. Since Ken has already warned me that we're not going to do 20 questions today, he's a realist. We will be coming back with a part 2. We'll do as many as we can get to today, but we're 30 minutes in, and I think we've only done, what are we on? Question 2. All right. In that case, in true unhurried fashion, I got to tell you guys, there is a story on Manifest Investing about the St. Louis National Convention where the photographer from the St. Louis Post-Dispatch was in the room with us as we did one of our sessions where we're talking about long-term investing, and he's taking pictures of everything. By the way, he took a picture and I was not pictured, but that's a story for another day. I'm still bitter, Ken. But again, to those of us in this community, you put this chart up there, take the name off, take the numbers away, and that's up straight and parallel, isn't it? And the photographer, he says, "Are you guys some kind of cult?" He says, "Because you put these pictures up there and the audience goes, ooh, ah." Some are actually tempted to dial up their broker on their cell phone. And, they put up another company and people snicker and giggle. And this is what it comes down to, understanding this company, O'Reilly, from the standpoint of, the big picture, that long-term picture, and coming up with an estimate. So, Ken, any thoughts on our St. Louis moment?
Well, I know we're not a cult. I know that we're much more than a cult because we give people real return. So let's keep moving here.
All right. This is kind of a cool question. We talked about it from a number of different directions, but what evidence shows that the projected annual return, remember, Ken already said there's a plus and minus, is correlated to results. Some companies over the last few years that have low pars have skyrocketed and continued to deliver returns. Skyworks and Danaher were mentioned by the club that we were talking with. Why? And airlines doing so poorly since March, why has the par of Air Lease remain relatively high? A couple things at work here that I think make a lot of sense. Over the years, I've compared notes with Mark Hulbert at CBS Market Watch and the various stuff that he's done, the Hulbert newsletter, which is no more, but it basically looks at newsletters. But Mark and I have compared the results of the value line median appreciation projection. Now, that's a mouthful. But basically what it comes down to is the red bars are what the company forecasts and value line add up to over time. So you see the red bars are fluctuating up and down. Again, if you go back to the horrible recession, note, Ken, that I'm no longer calling it the Great Recession. The horrible recession of 2008, 2009, notice that the return forecasts got way up here. And then just going back over the years, we had a really tough December 2018, and stock market forecasts individual stock forecasts got pretty high. And then what we went through in March of this year. So again, the red bars are the combined collective forecast of the companies in the book. Why is that important? Because they do things the same way we do. Value Line does a stock selection guide on every company that's in the book. They just do it with a slightly different twist where they use cash flow and price to cash flow and that sort of thing. So you can think of a Value Line book as a collection of stock studies that are done in a very similar way to stock selection guides at Better Investing or Manifest Investing. The important takeaway here is what actually happened 4 years later. And it ain't perfect. Ken already warned you that it ain't going to be perfect. And yeah, I'm using ain't wrong. I get that. I have grammar teachers probably rolling in their graves right now. But what I would argue is the shapes resemble each other with a couple of very challenging moments, here and here. But in general, this type of study of companies produces pretty good results. That would argue for a back up the truck moment in March of this year. We talked about backing up the truck in March of this year. I think that this makes a case for, the collective performance of the studies that we do. Does that make sense to you, Ken? We're going to talk about the individual companies here in a minute. But
it certainly does, Mark. And what also makes sense to me is that when we're talking about a lot of these values, we have to be extremely precise on the vocabulary we use. I'm beginning to see in some of these questions that are coming from our club, and they're great questions. They're terrific, thought-provoking kinds of questions. But one of the things I learned as I studied to be a negotiator was that you have to take and spend as much time looking at the premise of the assertion that your opponent is making, as well as looking at what the assertion itself is. And the premise on some of these things here, I think, comes from the fact that we're based on different ideas, on different vocabulary. I'm not so sure that I need to compare the low par potential annualized return 5 years from now with the appreciation happening at 15% on the day that we might be measuring something. The time units are different. The whole concept of what's going on is different. And this graph is very precise, and we have to know what it is we're looking at here.
Mm-hmm.
We're looking at something that's extremely volatile. You can see that those are monthly bars, so it's extremely volatile, and it gets even more volatile when the stock market does really weird things, like it did in March, or like it did in December of 18, or back during the recession horrible. When we're coming, that's my new name for the Great Recession, Mark. Okay.
I'm stealing.
Okay. But
Yeah.
I think that we have to pay attention to the vocabulary and what the heck it is we're measuring, as well as just paying attention to the numerical value itself.
Yep, good points. And again, this work has been published in the Wall Street Journal a couple of times. It's out there. In fact, we gained a subscriber last week based on the last time it was put out there. The other thing that I would urge everybody to recognize, and this dovetails with what Ken was just talking about, the rule of 5 is real. And the rule of 5 has to do with expectations. You do 5 studies, and the nutshell version of the rule of 5 is 3 of them will come out pretty much the way you think that they're going to come out. Let's say you did 5 stock studies and they all had a par of 10%. They're not all going to see an actual return over the next 4 or 5 years of 10%. 3 of them will be close to 10%. 1 of them will be 40%, and the other one will be minus 40 or something like that, just to make a point. There's always going to be a distribution of results, actual versus forecast. And the other thing to keep in mind is that those forecasts are a snapshot. They're static. They're fixed in time, yet the things that go into those forecasts are very dynamic. So they're constantly changing. So the forecast assumptions from 4 years ago could be pretty it's just a long-winded way of saying what Ken just said. There's a lot of dynamics involved here. Any thoughts on that, Ken?
Nope, I fully agree and fully believe in the rule of 5. And that we've done some work to try to mitigate that rule and to try to make it less impactful on our portfolios. So maybe we'll get there today and talk a little bit about that work.
Probably not today, but probably next week. All right. Danaher was mentioned, and this is another point that we want to make. When you're talking about growth and appreciation, make sure you recognize them as 2 different things. Growth refers to top-line growth, sales growth. Appreciation is the change over time in the stock price. The other point that I would make to the comment that was made by the people who submitted the question is, I don't think you can make any judgments at all about 2 to 3 years of virtually anything in the world of investing. So, it really is short term. But the other thing to really remember, and this one demonstrates it, this is one of their biggest holdings and probably one of the best purchases they've ever made. It's when stock price performance is strong, and we're going to look at that down here. This is what we refer to as a chronicle at Manifest Investing. These are monthly prices going back to December 2016. So these are monthly stock prices starting somewhere down around, let's call it 60 or 70, and ending up fairly recently, I believe it got up to 248. Does that sound right, Ken? So the stock price went from 60 to 248, and you can see that the stock price has been doing pretty well for this company known as Danaher. Under those conditions, if the fundamentals are basically steady and the same, you're going to see the projected annual return again, these are all snapshots, decline. A stock price that is steadily increasing or perhaps even suddenly increasing will result in a reduction in the return forecast or projected annual return. And we now see that Danaher is trading at, one of the lowest. In fact, it went sub-zero briefly, probably while the analysts were catching up. But strong price performance will drive that sort of thing down. What are your thoughts on this one, Ken? Because this is something we run into this question a lot.
Well, we run into it constantly, and people, I think, misrepresent PAR as having something to do with how good or how bad a company is. PAR is not measuring how good or how bad a company is. PAR is measuring the return, and that return has a lot to do with what it's selling at this moment and what the future projections that you make yourself in your analysis have to do to affect what it's selling at this moment. PAR and quality and goodness of a company can be tied together, but that's very rare, and that's an example of a company where the wheels are falling off, where the bus is careening down the road, and we have no way of understanding where it's going to go next. But that's not the case for most companies that have lower PARs.
Another thing I can say here on Danaher is, I can't remember when, but it was sometime this year, I recognized where I saw two of the founders of Danaher were backing up the truck on the stock. So one of the things, if anybody has any questions about what's going on within the company and they're unsure, find out if any insiders are buying it. And are they getting greedy? Are they buying 100 shares, or are they buying enough that it's $1 million worth or $2 million?
Absolutely. Put it in context and figure out if there may be certain clues there. All right. The other question that came from this club had to do with Air Lease, and this is one that we run into a lot too, so I thought I would feature it again. Here's the quick snapshot. You don't even have to know the name of the company to recognize that there's some fairly positive things going on here. But what we run into as investors, and Ken mentioned patience and discipline, is the challenge of what I refer to as a price plateau. You can call it a mesa, you can call it whatever you want. The stock price for Air Lease, and I know Kim will have something to say about this one, basically got stuck in the mud for at least a 3, maybe 4-year period. And when that happens, when you have this type of thing happening, alongside improving sales, improving earnings, everything down here looks like it's improving. The PE ratio is maturing. You want to be careful about getting impatient with a company with a picture like this. You want to give them a little slack, because this is a company that it seems to be continuously improving. The only thing that's not improving is the stock price, and that can really spell opportunity. So that's the short answer. Watch for the stock price plateaus. If you really want to look at this demonstrated in spades, find a long-term price chart for Home Depot and make note of how many 3 or 4 year flat spots they have in their stock price. So that's the longer answer. There's the short answer is the short answer here, but the long answer to the question is ask Matt Spielman. Matt Spielman is a Manifest Investing contributor, and he talks about Air Lease a lot on the Manifest Stocks forum. You can get more information there than you can get from the 3 highest ranked experts on Wall Street. Matt covers it all. Ken, your thoughts on this, and I know Kim will have a thought too.
I'll defer to Kim. Go on, Kim.
Well, the thing that I've always learned is my investment club has Air Lease, full disclosure. And during the holidays, we all get busy and we all, okay, we're going to go enjoy our families. And we had cash sitting on the sidelines, and we decided what stock we would like. And we put a buy out there as a Hail Mary. Oh, it's never going to hit, but if it does, it's great. And you never are going to know when the market will go sky high or fall. Well, we had a buy order in for at the time the stock price for Air Lease was like 45, and we put a buy order in for Air Lease at 30 last year. And boy, were we all happy when we came back in January and realized that it hit. If you have one of these companies within your portfolio that is doing everything right, as Mark and Ken had said, and it took me a long time to learn it, patience, patience, patience. And if you'd like to add to it, that stock price went down for probably 10 minutes one day. And all of us get busy with our lives. So if you want to put some money to work, it may or may not hit, but it's always a wonderful time when it does.
All right. Watch for the plateaus and be patient.
Yeah.
We'll get through a couple more of these. This one will be a quick one. I'll just make some editorial comments. PAR is updated daily as stock prices change, yet earnings and sales are reported quarterly. Sometimes PAR changes rapidly and significantly over just a few months. And then they tossed around some questions about, basically, does this stuff bother you? The answer is no. It's not really a concern for me. And FYI, the updates, the fundamental updates are much more frequent, especially with the smaller companies. But they're much more frequent than they ever have been. So we are catching this stuff. The one area where this comes into play, and Ken warns you guys about this all the time, when you're looking at a relatively small, faster growing company, sometimes you can have 1, 2, or 3 analysts covering the company. And if they change their minds, it can really chuck the fundamentals around pretty massively, a lot of turbulence. So we can see that. How should they regard a decline in PAR? And this goes back to what Ken was talking about a few minutes ago. This club was wrestling over the contribution that PAR should make to their decision making. We rely on it a lot. When it comes to selling decisions, we basically look at the PAR as one of the primary triggers. It's not the only piece of information, but we're always comparing the PAR, the result of a stock study. I consider the PAR the bottom line result of a stock study. We're always comparing the PARs for our companies versus target ranges, and we're going to talk about core and non-core companies in a minute. We regard them differently. But the other thing that comes in, and it comes in a question later, they talk about, what if that company is stuck in the mud for 3 quarters? That really doesn't have a whole lot of influence on us. Any quick editorial comments on this one, Ken?
I just would jump in with both feet, Mark, and second everything you just said, that the low PAR values for a company help us determine selling prices a lot of times, selling situations a lot of times. And on top of that, we need to be aware in a club especially that you meet once a month and you make one decision a month. And if you met at the wrong time or your decision was reversed in the next day, you just have to live with that issue. You don't have those constraints when you're an individual investor. You have a continuum where you can buy and sell at any moment that you choose. But in a club, it's once a month for one decision or 2 decisions or 15 decisions, but they're all happening at the same day. And you have to live with what happens, and you shouldn't have this feeling of remorse when you make a mistake. You should just learn from it. That's all.
All right, I'm going to move forward because we are going to cover the selling decision stuff in much greater detail in a later question. So let's just keep pressing on. Question number 5, often the stock equity guide PAR and the PAR and the Eagle are the same, but sometimes they're not. I believe this question was in reference to the My Studies portion at Manifest. That's where you can pull up income statement analysis for any company that you want to study. And the stuff here is current conditions, and the stuff out here is 5 years out. And any one of these green boxes, you can actually enter in the figures. Now, these figures are actually imported or pulled from a variety of different places. Part of the answer to this question is, I don't know. The second part of the question is, it's probably related to erratic data from a number of different places, including our dear friends at Yahoo Finance that pulled the rug out from under us not too long ago. I'm not holding too much of a grudge, but we were only pulling a tiny amount of data, and they basically put a stop to that, or worse than that, they actually messed up the numbers, with their data field assignments. This will go away. As we move through the next design iteration, this concern will go away completely because we'll be feeding the numbers differently.
I want to add a comment, Mark. When data doesn't seem correct, there are times for you to say to yourself, I need to check it. I don't know how many of you use the Better Investing data feed. I know many of you do. And I don't know if many of you realize that for about a week and a half, the entire data set for Dollar General was completely incorrect on the Better Investing data feed. Now, it had nothing to do with Better Investing. Morningstar had made a big mistake in that data for that company, but for almost 2 weeks, that data was coming through as just completely off the wall. When something seems wrong, there are times, because we use data from a lot of sources, when it is wrong. So challenge it in your mind. Think and look for some supporting data to the number you feel is wrong, or look for some supporting data to refute the number that you think is wrong. There's not only one data source out there.
Yeah, trust but verify, and make sure you understand the different flavors of data. It's all part of growing as an investor. All right, and along that same subject, question number 6 is, how many analyst estimates are used by us to estimate the par? We already showed you how we do it. Which ones are used? Are they averaged? Are they weighted? I don't tend to think of it that way. We showed you exactly how we use it back in slide 5, where we talked about O'Reilly. We embed those analyst consensus estimates, and those change all the time, basically daily. Not a lot for a company like O'Reilly, but for others it could be more. What you're looking at here is a Y-charts excerpt of, here's the 2020 estimates, including earnings and revenue for O'Reilly. Same thing down here, earnings and revenue, the average for 2021, 2022 for earnings and for revenue. The revenue's down here. So again, these are the numbers that we are watching on a continuous basis. And I do want to make the point that the parameters of, the various data parameters at Manifest Investing that we use are truly an aggregation or a composite of information that is retrieved from Morningstar Value Line Y-charts, which provides the numerical data for the most part. S&P is now CIFRA. I think that's how you say that, CFRA. And again, it's coming from a number of different places. So, Ken, any embellishment on that, or should we just press on?
Just press on, Mark.
Okay, because it all applies here. What are the sources used to estimate projected sales growth? Like we showed, and again, this comes back to maybe a little bit of distortion of understanding here, because they're talking about appreciation and sales growth in the same breath. You want to make sure not to confuse the two. We do use the value line composites as one forecast mechanism, but they're not directly related. And just like we said in the opening, back in those preliminary slides, this is where the 7% comes from, guys. It's pretty straightforward, slope of that line. There's also a fair amount of concern among many of the clubs that we interface with that are concerned about, well, you only seem to follow a value line. And yeah, we follow a value line, but we follow the complete database at Value Line. There's more than 5,000. It's actually more than that. It's probably closer to 7,000. And there's even more in Y-charts and Morningstar. So the thing to remember is when you're dealing with a company like Neogen or a relatively small company, there's no change whether it's covered in the standard edition or the non-standard edition. The only thing that goes away in this particular analysis is this point for a company that's not in the standard edition. Not a major moment. And so the method is unchanged. Okay. Let's go ahead and go to this one. Question number 8. The projected future price is calculated based on a number of things. And again, we're repeating here just to drive home where many of this stuff comes from. Sales growth forecast, projected net margins. Again, think back to that visual analysis in the cult set of pictures that we look at all the time. drifts in outstanding shares adjusted for future buybacks. Yeah, all that stuff is in there. The stuff that Kim was talking about a few minutes ago, average PE ratios, which can be among the most challenging things. So can you explain it further? How do we look at the relationship between sales growth and EPS to estimate sales growth? Again, we've showed you what we look at. Go back to slide 5. There's also a question out there about, do we provide EPS growth estimates? And the short answer is no. And that's not because I'm being obstinate or difficult. What we're trying to reinforce is that we use the preferred procedure 100% of the time. So rather than use the type of visual analysis type estimating that you see, there's nothing wrong with that. We just think that a deeper understanding of the company you're studying and considering ownership of is just enhanced by understanding the top line and then the profitability in kind of a two-step dance. So the EPS growth rate to us is an outcome. It's not an input. And so you can take any company analysis, you can see it for Stryker here, and do the math, compare the current earnings per share from the trailing 12 months to the 5-year estimate, and you can come up with our EPS growth estimate. We just don't think of it that way. Cy talks about this all the time. The one caveat, /earning or warning that I would give everybody, and we've talked about this for years at Manifest Investing, when you're looking at the EPS growth estimates at Yahoo Finance, it does come from a fairly broad distribution of analysts covering the company. I'm talking about the red circle. The caution that I would give to anybody listening is that number is quite often, in fact, most of the time, 50% high. So if you're studying a company and you're seeing 18% there, you want to think about, in terms of EPS growth, which again, we don't think about that much at Manifest, you want to think about knocking it down from 18 to 12 as you're doing your study and going through your point-by-point check process that Ken was talking about a few minutes ago. Any embellishment on that, Ken?
Yeah, Mark, I also think the starting point for that Yahoo number is not necessarily a trailing 12-month starting point. So for a really fast-growing company, you'll see significant divergence between the two numbers, especially as you move into the third or fourth quarter.
Yeah, and Ken is talking about, what if you measure starting at this point right here? That's obviously a whole different picture than starting at this point right here. That's what he's basically saying. All right, let's knock out a couple more questions, and I think we'll get halfway through it, Ken. We've got it's 2:58, so let's knock out just a couple more. Talk a little bit about quality and the evolution of how we follow quality at Manifest Investing. The 4 components of quality are shown there. The financial strength of the company, again, that is how formidable the balance sheet is over time. By the way, George Nicholson started his guide to investors with an entire chapter on the balance sheet, which somehow doesn't make it onto the stock selection guide. More to talk about that later. But the earning stability, we like up, straight, and parallel, so that's nothing more complicated than the straightness of the earnings trend line over time. And then we do something else where we compare the relative profitability, the net margin of that company versus its competitors or peers, and we do the same thing for growth. And those are the 4 components that basically match the definition put forth by Benjamin Graham in his classic text, Security Analysis, back from circa 1930, just after the Great Depression. And they also align completely with George Nicholson's definition of quality. We're going to talk about that quality penalty in a few minutes. If you want more on this subject, if you go to Google or Manifest Investing and you search on the word, Manifest Investing and the word excellence, do not search for quality because obviously you'll get a million hits. Or you can go to this cover article, which gives you our perspective, basically the recipe for how we define quality. All right. Anything on that, Ken, or should we just press on to defining it?
Press on to number 10, right?
All right. How does it matter? And this is something we do want to talk about just for a moment as we close down for this month, or this week, I should say. We think that you do have to, much like your children or grandchildren or whatever, you sometimes have to treat them a little bit differently. That's there's no right or wrong. It's just a matter you have to customize your approach many times. And we think that you do treat companies that are core or high quality differently than companies that are not. And this has been featured a number of times at our roundtables. That's a cover slide from May 2019. And we're just making the point that we don't believe that a company can really be a high quality company if they haven't gone through a recession. I just teed it up for you, Ken. Go for it. You're kind of the reason that we have this rule.
Well, I agree with this rule. Now, is the adjustment that we're making to quality necessarily correct right now? No. Can it be made better? Probably. Does it need more discussion and maybe more nuance to it? Perhaps. But we are making an attempt to let you know that we don't consider a company to be fully in the highest quality echelon until it has been able to go through a recession. Now, certainly everybody that's in existence today has been through a recession now in March of this year, and maybe we're still in one. So maybe we'll have to eliminate some of our penalties going forward. But we know that there are reasons why companies in our database shouldn't be compared to a Microsoft or to a Johnson & Johnson or to some of the other highest quality companies in the database. And we have instincts that tell us that there are good reasons why we should penalize for the quality. Help us make the decision. What do you think are good reasons for penalties attached to quality? We think there should be one. Now the question is, what's appropriate?
Yeah, and just to put a finer point on it, Ken would call me up and say, Mark, here's this company. It's got a quality rating of almost 100. And I'd say, yeah. And I'd pull up the visual analysis. I said, isn't that beautiful? He said, Ken, but then Ken would come back with, but it's only got 3 years of history. And we haven't had a recession in 10 years. So his point was well taken. Until a company is tested, you have no idea what's going to happen to them in a really economic test, as we say there. So that's why we do that. And let's go ahead and close out with this one. Again, just a more discrete definition of the stuff we mentioned on that cover slide. We basically calculate a quality score or a calculated quality rating, as you see here, for every company. And it features taking a look at the financial strength of the company. Again, this number here is going to be, what is Value Line, Morningstar, S&P, what do they say the financial strength of the company is? They usually give like letter grades. That 95 would be equivalent to an A+ at Value Line. And then we also take a look at a thing, the effective interest rate paid by a company. That tells you how the financing institutions actually view the company. And then we convert that to a 25% score. Each one of the the four categories are equally weighted. Earnings per share stability, again, it's just the straightness of the line, including forward-looking estimates. So again, that accounts for 50% of the score. Then we compare the growth rate of any company versus its industry growth rate. And again, that is weighted to be 25% of the score. We max it out at 2 times. Again, refer to that article if you want to take a look at how we specifically do it. But those 4 are equally weighted. And again, those last 2 columns comparing the company's growth rate or profitability versus its industry as measured by peers and competitors. And we take that score, and this is a change we made several years ago now, but we take that score and convert it into a percentile ranking. And here I'll turn it over to the teacher.
Well, Mark, if any of you have any experience at all in doing any standardization of scores, any kind of scores, whether they're test scores or scores based on batting averages or whatever you want to measure, we can always take a raw score, which is an actual numerical value derived from some definition. It could be the number you got correct on a 10-question test. And then we want to scale that score because we'd like to know how many of those scores we're falling into the top quartile or the top quintile or the top decile, quartile, quarters, quintile, fifths, decile, tenths. And we'd like to see if our data ends up approaching a nice normal distribution, which would be a bell curve. So when we take the 77.4, that's a raw score. Now we scale it. In other words, the highest raw score would be given a percentile rank of 100, and the lowest raw score would be given a percentile rank of 0. And then in between, we would scale these scores, and you can get your spreadsheet to actually do a scaled score based on raw data. Once we end up with that scaled score, that's telling us then where the score stands in relation to all the other scores in the database. That's a pretty roundabout way to explain that there's no difference between these numbers except for their magnitude, except for the way they appear to you. The highest is still the best, and the lowest is still not the best.
When we first started, we used to almost have a secret handshake where the top 20% of all companies had a raw quality score of 65 or greater. And we just learned over the time, especially in dealing with people that are new to our community, that we had to provide more context. So you could have a company with a raw score of 89, but that was actually the highest score out there. That was the top. You know, it got a quality rank of 100. So it gives you instant context for those of us that have not been involved with the secret handshake for a few decades. I think we could probably, let's knock out these two, and that way we'll start on question number 13. How's that for bad luck? We'll start on question number 13 next week because we are at 68 minutes. Just to reinforce what we're talking about here, which quality number do we throw around on all our chronicles and on the company report pages? I think you've already guessed it's the one with context. It's the percentile ranking. Some of the people in attendance were talking about beta. We don't pay much attention to beta. We could be wrong. I doubt it. What quality for us does deliver, and why this is so important, is this notion of embedded insurance. We might talk about that in a little greater detail next week, but it is a stabilizing joy to me and to many of the investment clubs I'm affiliated with, to have enough quality that when we get a challenge from the economy or whatever causes a disruption, quality matters, and it's just a beautiful thing. And we'll close with number 12. What does a red quality number mean? Just like Ken was talking about, everything is ranked in quintiles. Are they near or about to go bankrupt? It simply means that it's in the lowest quintile. That's what the definition is. Doesn't necessarily mean they're about to disappear from the planet, but it's certainly a warning light. It's certainly also a reminder that if you're especially in an all-male investment club and willing to chase some of those turnarounds, sometimes companies do recover and go from a very low quality to a better quality in the future. But you're talking about a company that can be damaged goods, and any time that you're playing in that realm, I think it makes a whole lot of sense to make sure you understand the liabilities, the cash that they have in the checkbook. This is stuff that we publish on our reports and at the Manifest Investing website. We will talk more about this subject in the future, this projected return on value. But the one I want to draw everybody's attention to when you're looking at a company, and this is part of the quality calculation at Manifest through the financial strength, we pay a lot of attention to at what rate, similar to a mortgage, at what rate are banks and financial institutions willing to loan money to this company. So whatever company that is, 2.6% is a pretty darn good interest rate. The bank or financial institution is perceiving minimal risk to loaning money to this company. And that can be a very important thing to think about. If I'm looking at a company with a red quality number, and then I look down here to this and I see an effective interest rate of 11%, it's like all of the warning lights on my dashboard going off at the same time. you know, my daughter would call, I'm on the highway, Dad. These 3 lights just came on. What do we do now? I say, it's time to pray, Lindsay, that the engine survives this moment. But that is how you want to think about this stuff. Understand the balance sheet nature of the company. Ken, do you have something you'd like to add to that? And I think we can close.
I don't, but Marshall has her hand up, so I'm going to unmute her. Michelle, I can't unmute you. You're muted on your side. So if you want to speak, you have to unmute yourself, Marshall. Okay, I'm going to assume that's an inadvertent hand, Mark, and we'll continue.
Okay, so we'll pick it up at question 13. That'll be a good place to start, kind of like returning from summer vacation next Tuesday. That's kind of where we started. We'll start on question 13, and we may add a few questions depending on how we feel about what we've got to cover. If you are looking over the handouts and you have something you think is just a burning question that should be at, please go ahead and send an email to me. I'm going to go ahead and skip over the Bullish Library, other than to make sure you guys are aware that it's there. We've been featuring books over the last several weeks, and the 3 large ones on the left are the ones we talked about last week. We will continue to do that, but that's a pretty good Christmas reading list, I think. Kim's read them all, by the way.
That's
No, I haven't.
That's a pretty good 2021 reading list, Mark.
And then we'll talk about excess returns. Quick reminder to anybody that's here, we do archive all of these recordings at youtube.com. Just search for Manifest Investing. We would love it if you would subscribe if you'd like to be reminded anytime that we do add content or another session. The 5 recent sessions from our Successful Investing Conference are right there. All 3 of us were part of that over a few days recently, and I wouldn't be surprised to see one in the future as soon as the numbing Novocaine is off from the last time around for Ken. All right. So happy holidays. We'll probably continue with that theme next week. We will persist with the questions. And with that, I think we can go ahead and sign off. We will stick around for a few minutes. And thanks, Kim. Thanks, Ken. And we'll pick it up where we left off. And thanks, everybody. We hope you enjoyed it, and we will press on. What are we at? We're at the 14th of December. Especially to the guys in the audience, you have approximately 10 shopping days left. 5 days, I think it's 5, maybe even 3, if you're ordering stuff online. So that is our public service.
I think it's the 15th of December, Mark.
Are we on the 15th? We are on the 15th. So 9 days, yeah. 9 shopping days, maybe even 8. I don't usually start until the 23rd or 24th. So
then you must do local and not do shipping.
I've actually done more online. Anyhow, that's our public service announcement. Thanks, everybody, and bring out your best ideas and questions, and we'll see you next week. Thanks.